Delivering superior investment results with low fees is really important so that people aren't left behind. And we're managing money for everyday people to save for retirement, to save to put their kids through college. It's incredibly exciting, but also a huge responsibility that I certainly take very, very seriously every day.
Opportunities in the market today. There's a lot of things going on geopolitically. Where are you seeing opportunities?
Healthcare is a sector that has underperformed the last few years, particularly when I look at managed care. I think that over the next couple of years, the cost trends that have been a problem are going to normalize and underwriting margins will recover. And I also think that there's still enormous growth opportunity from these companies helping to make the healthcare system work better for patients, for doctors, for payers.
New analysts make mistakes. What are some of the mistakes you've seen new analysts make?
Well, I would say kind of one of the biggest mistakes new analysts make is...
Today we have Diana Wagner with us. She's an equity portfolio manager based in New York City. She's been at Capital Group 24 years. Diana, welcome.
Thank you.
Glad you are here and with us. A lot of folks like to learn how people came to Capital Group. So maybe we can start and tell us how you got here.
Well, I appreciate that. And thanks so much for the opportunity to be on your podcast. And I guess you could say I was a late bloomer. I didn't grow up reading the Wall Street Journal or following stocks. I was actually born in Latvia, one of the Baltic countries, when it was still part of the Soviet Union. And my mom had become a widow at age 29. And in 1980, at age 35, she decided that there was no future for her kids in the Soviet Union. So she brought us to America as refugees. And I was 7 at the time. My older brother went to study physics to become a doctor, and so I was supposed to be the lawyer. And probably the greatest gift my mom gave me was trusting me to figure it out with an art history major. And so when I was graduating, I didn't know what I wanted to do, certainly knew nothing about finance, but saw that a lot of smart other humanities majors around me were going into investment banking. And so armed with a good math SAT score, so they knew that I could add and subtract, I tried for that too. And banking was a tremendous learning opportunity. But after a while, I realized that it's really a transactional business where you're going from deal to deal, and I didn't find that very satisfying. So as I was about to head to Columbia Business School to figure out what I really wanted to do, a former banking colleague of mine, Tony Kim, said, Diana, why don't you apply for our summer internship here at this investment firm where I'm now working? And because I think this investing thing may be more your temperament. And so I was lucky enough to get that opportunity, and it just opened my eyes. I couldn't believe that there was this job where you get paid to learn and paid to seek the truth. And so I was hooked, and it gave me direction when I went to business school. And then I was so lucky to get hired by Capital when I graduated almost 25 years ago.
So you never took the LSAT. You didn't have to go to law school.
Oh, no, thank goodness.
So art history and investing, how do they work together? Because I was a history major, and people say the same thing to me. So how does art history and investing work together?
Well, I never really figured it out myself until about 15 years ago. I ran into a former art history professor of mine at a cocktail party, and she asked me, what are you doing now? And I said, I'm an investor. And she said, that makes perfect sense. I said, oh, good. Please explain it to me so that one day I can tell our CEO on a podcast. And she said, well, in art history, you're looking at an object and trying to see things that other people don't. And it's the same thing with stocks. You're looking at a stock and trying to see a narrative that other people don't. And I was so impressed by this, Mike. And then when I got home, I realized she could have probably said that to a lot of other people in a lot of other professions, because it really just reflects the value of the liberal arts education and how it teaches you critical thinking. But of course, if you think about it, there's one big difference between art and stocks. With art, there are no right answers. And with stocks, the market tells you whether you're right or wrong every day. And I love that.
Yeah, and some of our investment professionals, even in what they do every day, some of them do it in an artistic way and some in a very scientific way.
Right.
So I think that's always interesting. We say we have artists and scientists, and you came from the art history world. That's great. Let's get into your investment style. You talk about investing in high quality, steady compounders. Again, unpack that for us. Give us some examples of what that means.
Of course. Yeah, so I do gravitate toward durable growers that can thrive in a variety of environments. And I would say probably about 40% of my portfolio is in stocks like this. And these are companies with kind of durable growth runways, great management teams, and expanding moats. And I see these stocks as serving both an offense and a defense role in my portfolio, where they'll keep up in good markets, and they'll also provide some downside protection in down markets. So, and a bunch of these are kind of companies that I would call toll collectors on growth highways. So businesses like insurance brokers like Marsh Mac, or healthcare services companies, or payment networks like MasterCard. And maybe I'll just touch on MasterCard for a minute and talk about kind of why I like that company. So, MasterCard has this network where they connect banks and merchants and consumers, but they don't issue credit and they don't take financial risk, but they charge a small fee every time a transaction goes over their network. So it's an incredibly asset-light, high-margin business with this incredible moat that they've invested in, this network that they've invested in over decades. And a few years ago, there was this whole hullabaloo when we had this fintech revolution, and people thought all these startups were going to disrupt MasterCard. But now we see, turns out, all these guys, PayPal, Klarna, Affirm, they all see MasterCard as a partner, and they rely on MasterCard's network infrastructure for their business as well. And so this has been an incredible compounder. They've grown revenues at a 13% CAGR over 20 years and only had one down year, and that was during COVID. Of course, they're leveraged to global GDP growth and continued digitalization of payments, but also they've been investing in value-added services like tokenization and cybersecurity, which are not only enhancing their growth rate, but also helping to expand their moat.
What's interesting about that is that growth rate is so much higher than global GDP growth. So yes, they're toll collectors on these high transaction financial highways, but at a 2x, 2.5 times rate than global GDP growth. So they're doing something.
Well, digitalization kind of was accelerating. And so there were a lot of trends that were helping them accelerate growth.
It's a great mindset. Companies, let's go to companies and company managements. You are known within Capital Group as being a bit of an expert on companies and managements. Why is that so important in your investment process? Why does that matter?
Well, investment management, in investing, company management is definitely an important part of my process. And what I've observed across a number of industries is that the gap between the best and the worst companies is not necessarily scale or better products or things like that. It's really management skill. And the best management teams, they have a long-term vision. They can see around corners and invest in big trends way ahead of their peers. They have a focus on operational excellence, and they're great capital allocators. Now, let me share with you two stories. The first is about a company called Molina Healthcare, which, with a change in management, went from being bottom of the pack to being top of the pack in their industry. Now, Molina is a Medicaid managed care company. It's a company that I followed when I was an analyst. And Medicaid is the government healthcare program for the poor. And what Molina does is they help people navigate the healthcare system and get better access to care. But this has been a growth market because states are increasingly outsourcing their Medicaid spend to companies like Molina because they can do it a lot more cost effectively and drive much better health outcomes. But this is a very difficult business with very low margins, 1% to 2% net margins. So your kind of margin for error is very narrow.
It's a volume business.
And also, if you make an executional mistake, then that can be just disastrous. And so Molina had terrific assets, but it was run as a family business. And the Molina brothers, the CEO and the CFO, were not disciplined operators, and they often made choices that prioritized family interests ahead of shareholders. And so the question with this company was never, can they grow? The question was, can they make money doing it? And they brought in an outside CEO, Joe Zubretsky. And I had known Joe from his time as CFO at Aetna, and I knew that he was a ninja. So the day that he was announced to be CEO, we bought a lot more Molina stock. And it was really incredible to see just within a couple of years how he was able to transform Molina and take them from bottom of the industry to top of the industry in terms of both margins and growth.
I'm sure when he was announced as CEO, as being a real operator, the market probably went up a bunch that day. And you think about it as a $1 billion market cap to an $18 billion market cap, whatever it was. you were still buying because for the very long term, it didn't matter what happened that day. You were thinking of the next 5 and 10 and 15 years because you finally had management that you trusted. I mean, is that an accurate
exactly
portrayal?
Right. And the fact is, kind of people think incrementally when they're thinking about changes that can make, and they couldn't fathom how much more profitable and that this could actually be a growth company and have good margins at the same time. So people just kind of lack imagination in thinking how good things can be when you have a really great management team in place.
So great assets, great management, long-term opportunity.
Exactly.
Okay. So you had another story too, though. I don't want to miss that.
Well, one of my other favorite management stories is ASML. And ASML is probably the most important tech companies that a lot of people still haven't heard of. They're Dutch, and they make this incredibly complex lithography machine that uses laser light to transfer a chip design onto a silicon wafer. And so think of it like using a very, very fine laser pointer to draw a city on a grain of sand. So if you can't transfer the pattern, you can't manufacture the chip. And ASML currently dominates this market for leading-edge lithography tools. But ASML is an interesting example of the fact that sometimes it's not all about the CEO. Sorry, Mike.
That's okay. I'm glad it's not.
When in the early years of covering this company, they had this CEO who was just, very disappointing, but it didn't take me long to figure out that it was actually he was not the most important person in the company, that instead it was Martin Vandenbrink, the chief technology officer. And Martin was this intense genius who understood what his customers needed years before they did. And so every year I would come to Veldhoven in southern Netherlands and visit him and seek him out and talk to him about what his customers are thinking and what he's working on. And Martin was just this incredible person who he was never bullish, but he distinguished between the science problems and the engineering problems. And the science problems were the hard ones, and the engineering problems were more manageable. And I knew that if he said he was 70% confident that a product would work, it was a done deal. And so ASML did eventually get a great CEO, Peter Vennick. But interestingly, he took the title CEO and co-president. And the other co-president was Martin.
Ah, okay. I think that CEO, you were also asked to speak at his retirement dinner.
Yeah.
And so why was that? And tell us a little bit of that background, because that says something. When you're asked to speak at someone's retirement dinner as a buy-side analyst or a buy-side portfolio manager, they clearly have a lot of respect for the relationship you built and how you got to know them intimately as a company. So how'd that happen?
Well, interestingly, so first, it was a retirement event for both the CEO, Peter, and the CTO, Martin. And so Peter was retiring after 25 years at the company, including 11 as CEO, and Martin was retiring after 40 years at the company. So it's almost like capital. And this was a huge privilege to be there. And I understand that the privilege came to me because of capital and the enormous respect that companies have for us. But, to your point, it does also reflect the relationship building that's really core to our process. And I think a key differentiator for us over time, and frankly, something that AI is not going to be able to displace. And so in my speech, I talked about my history with ASML. And when I first started looking at the company in 2000, it was really still more of a science project with really poor financial management. And it's hard to believe, but they were the underdog in a market dominated by Japanese giants, Nikon and Canon. But at the time,
about what year?
Around 2000.
Around 2000.
Yeah, so not that long ago.
Well, 25 years.
Yeah. But at the same time, kind of when I started covering it, they had this new product called the TwinScan. And this was an incredible machine, somewhere between a technological marvel and a work of art. But the Japanese competitors told me it'll never work. The stock market wasn't giving ASML any credit for it. But when I went to talk to the customers, like TSMC, I could see they were super excited about it. And of course, the product worked, and ASML gained a ton of share. And so, people say that investing can be about pattern recognition. And what happened next was a pattern of watching ASML take risks and innovate, and then prove the skeptics wrong time and again. There's one last thing that I wanted to touch on, just going back to my speech. And I kind of ended with this, that one of the things that I talked about was culture and the importance of language in shaping culture, both at ASML and at Capital. So at Capital, as you know, we talk about how language kind of shapes your mindset and also shapes your actions. And so, for us, gambling words are taboo. We invest our clients' money. We don't make bets, or we don't, make plays. And similarly, we talk about investment results, not performance, because results are something that's tangible, and
performance is a show, and this isn't about being a show.
Exactly.
Right.
And so similarly at ASML, they don't talk about customers or suppliers, they're partners. And they're not regulators or investors, they're stakeholders. So words matter. And I think that point really resonated.
Well, you were obviously an important stakeholder to them to be asked to speak at the retirement dinner of their CEO and their CTO.
Right.
That's great. But you also have a contrarian mindset at times.
Yes.
Share some of those examples.
Of course. Yes. Well, I am drawn to how to favor in cheap stocks, but there has to be something happening.
Can't just be cheap.
It can't just be cheap. There has to be some kind of catalyst. And so to that end, I'm like a moth to a flame when it comes to turnarounds. And particularly particularly in industries where there's a blueprint for how it's done, and where there are positive industry tailwinds, and maybe there's a new CEO who we know and admire from prior experience. So I think Starbucks is a great example of this. So this is a company that it's an incredible brand, but it's been mismanaged for years. I mean, their supply chain is a mess. The in-store operations were overcomplicated, and the culture inside those stores has lost a lot of its magic. And so interestingly, I think in many ways this echoes the Home Depot thesis that one of our great retail investors, Anne-Marie Peterson, pitched to us years ago, where we have kind of a founder-led company where subsequent CEOs damage the culture, but there's enormous opportunity from fixing the basics. And so, for Starbucks, in the restaurant kind of industry, there is a playbook for how to fix a restaurant brand. And in fact, the new CEO of Starbucks, Brian Niccol, he was responsible for two of the most successful turnarounds in restaurant brands. First, Taco Bell, and then Chipotle. And interestingly, the challenges at Starbucks really rhyme with what he saw at those two companies when he got there. And there was a lot of skepticism at the time about kind of how long this would take and how hard a problem it would be to solve. It hasn't been all that long, but so far things seem to be progressing faster than people thought. And already the same store comps in the stores are improving or not getting worse, kind of, and people are coming back to the stores.
And that same playbook is playing out as it had in the other stores at Taco Bell and Chipotle. You feel like that same story's playing out?
I feel like it rhymes with it, where, getting at the supply chain, getting at the in-store experience, kind of simplifying things. And also, I think upgrading management, kind of he's bringing in a lot of folks who he worked with in those prior situations. And I think it's going to be a really exciting combination.
All right, one to watch. So now I will do the office treasure hunt.
Okay.
And there's a CD in your office, and I have a Boston record in my office. You have a CD in your office, and the CD says Tech Zep 2001. So a real CD, which is always fun. I have that for my Jeep. I have an old Jeep, and it still has a CD player, and I love that car, and I love that CD player. Tech Zep 2001. What is Tech Zep?
Yeah.
And this was 24 years ago. Why is this CD in your office?
Well, Tech Zep, so this CD is part of the swag kind of from our 2001 Tech Zep trip to China. And Tech Zep is short for Tech Zeppelin. And that was the new name for our technology cluster, which started up in the late 90s. And Don O'Neill, one of our great tech investors, kind of came up with the name. And we were all kind of, part of the band. And so he and Mark Casey and a couple of others came up with these musical alter egos for us. So we had Mark Casey and the Sunshine Band, and Don O'Neill, and I was Diana Wagner. And then they had this CD where all of us kind of had our signature song. I had a great one, Ain't No Mountain High Enough.
Wait, are you going to sing that for us today? Okay.
I don't think you want to do that to your audience. Okay. but that was really fun. And but essentially, in 2001, we went to China to visit a whole bunch of companies, and to this day, TechZep as a technology cluster is an important part of our research process. And actually, just clusters have become an important part, not just in technology, but across other sectors as well. And so you can imagine if you are visiting, say, Samsung in Korea, and you've got in the room your telecom analyst, your semiconductor analyst, your semi-equipment analyst, your tech hardware analyst, you're going to be able to connect the dots in a much more powerful way.
That's great. I had a stat that was shared, someone shared it with me the other day. Our analysts and portfolio managers last year did over 21,000 company meetings, which is just incredible. And TechZep, you all, each time you do that, see a ton of companies.
And I would say that the value of those trips, the company meetings is like, 40, 50%. And then the other 50% is all the conversation on the bus.
And the colleagues getting together and literally on the bus from meeting to meeting.
Exactly. That's kind of like where the magic happens, where the dots get connected.
So in your investment process, I know you have a diversified portfolio, and I can also hear your passion around high conviction. How does that work? How do you have high conviction and also pretty strong and heavy diversification? How do you think of that?
Well, I say that I have quite a bit of concentration at the top of my portfolio. Overall, I've got about 40 to 45 holdings, but the top 10 is about 40%.
Okay.
And those are kind of some of those durable growers that are kind of high analyst convictions. And then the top 20 is about 60%. And I would say that I have high conviction in a good chunk of my portfolio, but I also like to leave room for stocks where I'm still building conviction. So I'll start a position at 1.5%, 2%, and then add to it as my conviction grows. But the question of diversification is one that I pay attention to very closely because sometimes stocks are a lot more correlated than you think. And we have this wonderful data analytics group, QRA, that I work with closely to make sure that my portfolios have the diversification I think they have.
And so if you build a small position, 1%, 1.5%, and then you gain conviction over time, that conviction can come if the stock is either down or up.
Exactly.
It's so
depends on the reason.
Right.
Yeah.
It depends on the reason. So it could be down 20%
Yeah.
and you're making it a 3% position just because your conviction grown and there's even greater opportunity. Is that
Or
fair?
it could be down 20% and it's out.
And it's out. If something is disappointing you for a fundamental reason and it's down like that, are you willing to have it go away to get it out of your portfolio?
And that's something that I've gotten better at over time. I think I used to be a little bit more patient and now, my bar's quite high.
So speaking of patience, new analysts make mistakes. What are some of the mistakes you've seen new analysts make?
Well, I would say kind of one of the biggest mistakes new analysts make is undercommunicate. Sometimes stocks are working, sometimes they're not working. And when they're not working, you just want to hide under your desk and stay there. And that's exactly the wrong thing. That's exactly the moment when you need to be communicating the most. You need to be writing, you need to be coming on our calls, because one of the beauties of our multiple manager system is that there are probably a couple of portfolio managers who don't own the stock with you. So what may be a laggard for some may be an opportunity for others. And so I think young analysts, as they're kind of building their credibility, it's important to err on the side of over-communicating.
And that's just walking the halls virtually and really walking the halls and just making sure they're knocking on your door and saying, we chatted about this company, the stock's down 20%, here's why I like it, or here's why, even though we're invested, we have to get out and take our loss and move on. But just be overly communicative. That's a good lesson in whether it's investing or management or anything is don't leave people to wonder.
Right.
So I'm glad you're sharing that with others who are investors. Opportunities in the market today. It's a volatile marketplace. There's a lot of things going on geopolitically. Where are you seeing opportunities?
Well, healthcare is a sector that has underperformed the last few years as there's been a lot of attention to the Mag 7, to AI. And particularly when I look at managed care, it feels to me that the market has completely given up on these stocks. And I understand the last few years have been tough for this industry. They had a post-COVID spike in utilization that led to disappointing underwriting margins at the same time that the tone and policies from DC have not been supportive. And today, people are looking and seeing potential and further regulatory headwinds and budget cuts from DC. And so a lot of the stocks are trading at multi-year valuation lows. And look, this is a sector that I covered as an analyst for a long time, and I have a lot of scars.
Right.
And I've seen a lot of cycles. But now with a bit of distance, it seems to me that this cycle is no different, but the market is treating the sector as if it's structurally impaired. So, I think that over the next couple of years, the cost trends that have been a problem are going to normalize and underwriting margins will recover. I think that the regulatory environment under this administration is going to prove to be a lot more favorable than people think. And I also think that there's still enormous growth opportunity from these companies helping to make the healthcare system work better for patients, for doctors, for payers, and also for helping Americans get more value from their healthcare dollars. So I think companies like CVS, United Health, and Molina are very attractive.
So this is the contrarian
Yes.
Diana at work.
Yes.
Okay, good. And the way in which we evaluate portfolio managers and analysts over the long term, 1, 3, 5, 8 years, with 8 years being the most important. I remember Rob Lovelace talking about his investment edge, saying his investment edge was time. So this gives you time to build a position,
Yes.
be a contrarian, be wrong for a while. And then when others are finding that value that you see today, you would have built that position with the benefit of time.
Exactly. That's the hope.
That's the hope. All right, that's good. Lessons learned. You talked about scars. Well,
So many scars.
and everyone says they have so many. It's it's a humbling business we're in. But share some lessons learned.
Well, maybe I'll highlight one. And the lesson here is that in order to thrive in the long term, you have to survive the short term. And a few years ago, we invested in a company called Wolfspeed. And Wolfspeed is the leader in making silicon carbide wafers and devices for high power voltage applications, including EVs and industrial power supplies. And this is very complex technology, very hard to make, and Wolfspeed was the best at it. And we thought their management was terrific because they had transformed the company, gotten out of a bunch of commoditized businesses, and really refocused the entire company on this exciting silicon carbide opportunity. But it's not enough to have great technology. You also have to execute. And unfortunately, Wolfspeed didn't execute well when they needed to scale the business. And so, one miss led to another miss and kind of cascaded into bigger and bigger problems. And I saw the signs, but I kept thinking, this is the bottom. It's not going to get any worse. And then they overextended their balance sheet as they were raising financing to fund capacity expansion at the same time that their core business was going into a cyclical downturn. So, I sold the stock on the way down, but luckily before they did a big dilutive capital raise, and it was a very kind of painful lesson. But I think the other lesson with this stock was that this management team that we thought we liked probably wasn't the right one for the company at this moment. So they were a bunch of kind of big company guys from very impressive places like Texas Instruments. But when Wolfspeed became more of a silicon carbide startup, they probably needed a management team that was scrappier, that was more focused on operational rigor and more paranoid.
So it's about the technology, but not just the technology. And
Yes.
it's about the management, but the right management at the right time. You're putting all
Exactly.
these pieces of the puzzle together.
Exactly.
Those are good lessons. Your investment edge, what would you say it is?
So, and you can probably gather this from my comments so far. I would say that my investment edge is my stubbornness, which sometimes, as you just heard from the Wolfspeed story, can be my Achilles heel as well. But the idea is that I can be patient, ignore the noise, and really focus on what the long-term drivers of the thesis are. And in this way, I've been able to identify some companies that have compounded for decades for us. But at the same time, sometimes the thesis breaks and you have to move on. And identifying that is equally important.
You also spend a lot of time with young analysts, and I've heard you in different meetings with them talk about capital group outside of investing and saying what we do for clients is really important, bringing it back to the mission, because we can talk about stocks and differentiators and investment edge and lessons learned and ideas. But at the end of the day, we're delivering outcomes for clients. Share that passion around what we do and what you do is so important for outcomes for people, for real people.
Well, it's what it's all about. I mean, delivering superior investment results with low fees is really important so that people aren't left behind. And we're managing money for everyday people to save for retirement, to save to put their kids through college. And so when I go to college campuses to recruit MBAs, oftentimes people will come up to me and say, I want to get involved in social impact investing. And I tell them, at Capital Group, there's enormous social impact to what we do, touching and transforming millions of lives through successful investing. So it's incredibly exciting, but also a huge responsibility that I certainly take very, very seriously every day.
It's so interesting in any company, in any business. How do you get your associates to have the mission drive their passion around the business? And we always try to remind our associates, we have 9,300 associates, 32 offices, 14 countries, reminding all of them that what they do impacts people's lives. It really does. Can they retire? Can they afford an education for their kids? How do they think about generation wealth transfer? All of those things, we're part of that ecosystem. That mission is critical to what we do. So I'm glad to hear your passion in that. I know you share it with others. Give us one mentor. And whenever I ask this question, everyone tells me there's too many. And I love that about Capital Group, but one mentor.
You're not going to let me give you two?
Okay, give me two.
They'll be brief, but...
See, that was just that easy. I just rolled over on that. Go ahead. Two mentors.
Okay, so the first is Dina Perry. And Dina Perry was one of our great contrarian investors. And she retired from Capital in 2022 at age 77. And I think that year she had the best numbers She
had great results. She did.
And she always taught me to stick with what I believe in until I don't believe in it anymore. And she also taught me to not follow the crowd. Those were important lessons. And then the other person that I wanted to mention is Jody Johnson. And Jody, she hired me. She was my first research director. And to me, she's investment discipline personified. She understands the difference between being bold and being reckless. And one of my favorite examples of that is her saying why she doesn't invest in IPOs. She said, let management learn on someone else's dime.
Right. Don't practice on me.
Exactly.
Yeah, Jody's great. She was on our podcast. She's also one of our senior members at Capital Group and part of our management committee and our vice chair. And I remember in the podcast with her, she is a differentiated thinker. I mean, everyone knows that about Jody. She's been at Capital Group for 34 years, but just that wisdom and that mindset of, yes, practice on someone else, but succeed for our clients.
Yeah.
I think that's a great mindset. Family, real quick before we finish up. Some couples do play golf together. Some play tennis together. You and your husband play piano together. So is this dueling pianos? How should we envision this? Are you sitting on the same stool side by side? How does it work?
We have a really big stool and we sit kind of side by side. But yeah, both my husband and I are big fans of classical piano. And usually you don't think of the piano as a group activity, but in our house it is. And my husband collects four-hand piano arrangements of a wide variety of music, from Beethoven symphonies to Mozart operas. And yeah, it's kind of weird, but we just like to sit there at the piano and read through them. And if you come to our house for a dinner party, which, Mike, I hope someday you will.
Well, I need to be invited, Diana.
Okay, you're invited.
Okay, I'm
Here
coming.
we go. Let's get our date books out. You'll probably be subjected to some of our piano playing, but the good thing about playing four-hand piano is that after a couple of glasses of wine, playing four hands really covers up your mistakes.
Got it. And I don't know as much about piano as others, so don't worry about your mistakes. It will all sound great to me. Does everyone in your family play an instrument?
Yes. To be in our family, you have to play at least one instrument, and both of our kids did time studying both the piano.
Did time. Is that how they viewed it?
You can ask them. So playing both piano and a string instrument.
Any other hidden talents, as if that weren't enough, but any other hidden talents?
I guess you could say I'm pretty good at ping pong. I did score a point off of Carl Kawaja once.
Okay,
So
we'll
I'm
have to
proud
play
of that.
ping pong as well.
Okay.
Let's finish up with a moment of gratitude. We love to finish our podcast with what folks are grateful for. As I share this mug with you, and thank you for being here today. What are you grateful for, Diana?
I'm really grateful for my exceptional colleagues. I get to work with some of the best investors in the world. And after almost 25 years, they become like my extended family. And I'm truly grateful for that.
Yeah, it's interesting because you mentioned half of the benefit of these trips you take together is seeing the management, spending time with them, the importance of management, as you said, and also spending time together.
Yes.
And it does become a family. I mean, you've been here 24 years. So many folks at Capital Group have been here 25, 30, 35, 40 years, and it becomes an extended family. So
It very much does.
I appreciate you being here and a leader in our New York office and an investor and a great piano player and a friend and all of the above. Thanks for joining us today. If you enjoyed the podcast, spread the word to somebody else who might benefit from hearing these great stories from our investment professionals. And also, please subscribe to Capital Ideas wherever you get your podcasts. And have a great day.